For decades, the world believed China was unstoppable, a rising superpower, an economic miracle, a nation that seemed to grow no matter what challenges stood in its way. But today, something extraordinary is happening, something that almost no country has faced at this scale in modern history. China's economic engine, once the fastest growing machine on the planet, is now breaking down from the inside, and the speed of the decline, the magnitude of the crisis, and the global consequences that follow are far larger than the world is prepared to accept. Most people still don't realize it. Most analysts still don't want to admit it. But China is not slowing down. China is falling, and the fall has already begun. To understand what is happening right now, you have to understand how China built its growth in the first place. For more than 20 years, China's miracle was powered by a single force: real estate. Apartments, towers, cities, highways, rail systems, industrial zones. Construction was the heartbeat of China's rise. Real estate reached nearly 30% of China's GDP, a level no major economy has ever sustained. People didn't buy homes to live in. They bought them to speculate. Developers didn't build to meet demand. They built because debt was cheap and growth was everything. Local governments didn't regulate the bubble. They depended on it for revenue. And as long as prices kept rising, everyone believed the miracle would continue forever. But economic miracles always have a cost. And in China, that cost has come due. Today, the country faces the largest real estate collapse in human history. The numbers are staggering. More than $6 trillion in housing wealth has evaporated. Entire cities sit half empty. Tens of millions of apartments that will never be occupied still stand as silent symbols of a model that has run out of road. Developers once celebrated as national champions have turned into financial black holes. Evergrande, the titan that symbolized China's rise, is bankrupt. Country Garden, once considered safe, is on life support. Hundreds of smaller firms have defaulted, and the ripple effects are everywhere. Chinese families, who put nearly 70% of their wealth into property, are losing confidence at a time when confidence is the one thing the system needs most. People are saving instead of spending. Youth unemployment has soared so high, the government stopped publishing the numbers for months. Local governments, drowning in trillions of dollars in hidden debt, can no longer fund basic services. And China's population, once its greatest asset, now shrinking for the first time in modern history. A demographic collapse combined with an economic slowdown is something no major nation has ever reversed, and China is facing both at the same time. What makes this situation so dangerous is that it isn't simply a market correction. It isn't a downturn caused by temporary policy mistakes. It is a structural decline caused by the end of a model that no longer works. China can no longer grow by building more homes, more malls, more cities, or more bridges. The demand isn't there. The population isn't there. The money isn't there. And the trust that once powered the system is disappearing. When consumers lose confidence, economies weaken. When businesses lose confidence, investment drops. But when governments lose confidence, they turn to desperate measures. China has tried stimulus. It has tried lowering rates. It has tried relaxing housing rules. It has tried encouraging banks to lend more. But nothing has worked. You cannot revive a bubble by inflating it again. And China's leadership knows this. They know that the era of double-digit growth is over. They know the country is entering a new phase, one defined not by expansion, but by contraction. And yet, the world still behaves as if China is the unstoppable force it once was. Investors expect a rebound that will never come. Politicians fear a superpower that is far more vulnerable than it appears. Corporations plan around growth that will not return. And global markets continue to underestimate how deeply China's slowdown will reshape the world. The truth is that China's decline changes everything. It changes global supply chains. It changes global growth. It changes energy demand, commodity markets, and investment flows. It changes the future of manufacturing. It changes the geopolitical balance of power. And it changes the economic assumptions that the world has relied on for decades. For the United States, this shift is monumental. China's slowdown creates both risks and opportunities. It weakens America's main competitor, but it also destabilizes global markets in ways that directly affect American consumers. A weaker China buys less from the world. It exports more to survive. It may turn inward. It may turn aggressive. And it may turn unpredictable. Economic pain has political consequences, and China's leadership is facing the greatest pressure it has seen in a generation around the world. Countries that relied on China's growth are now confronting a future without it. Commodity exporters face falling demand. Asian manufacturers face rising competition. European luxury brands face shrinking sales. Developing nations face reduced investment. And global growth forecasts, once held up by China's rise, are being rewritten piece by piece. What makes this moment historic is not simply that China is slowing down, but that China is slowing down permanently. The growth model is broken. The population is shrinking. The debt is overwhelming. The property bubble is finished. The demographic curve has turned. And the global system that relied on China as the world's engine of expansion must now adjust to a world where that engine is failing. Most collapses do not begin with chaos. They begin with disbelief when people refuse to accept that the old model is gone. China has entered that stage. The world is entering it with them. And the consequences will define the next decade of global economics. China is not dying. It is transforming. But transformation on this scale always brings pain before stability. And the world must prepare for the shockwaves long before they reach American shores. This is Global Collapse Report. Subscribe for clear, data-driven insight that cuts through the noise. The next chapter of global change has begun, and understanding China's fall is the key to understanding what comes next. There are years that pass quietly, and then there are years that change the direction of history. For months now, economists, analysts, and even central bankers have quietly warned that something unusual, something historic, is lining up behind the scenes. As the world approaches 2025, multiple long-term cycles, debt, demographics, inflation, geopolitics, energy, and financial liquidity are converging at the same time. And when cycles that normally move independently begin to collide, they don't create a normal recession. They create the kind of systemic reset that only happens once or twice in a century. The uncomfortable truth is that 2025 is shaping up to be one of those years. Not because of a single crisis, but because of the collision of many. The first cycle building toward 2025 is the debt cycle. For more than a decade, governments around the world borrowed heavily to sustain growth. The United States expanded its national debt by more than $10 trillion in just a few years. Europe did the same. China borrowed even more, hiding trillions of dollars in local government vehicles. For years, the world survived this binge because interest rates were near zero. Debt was cheap. Borrowing was painless. And the illusion of stability was easy to maintain. But today, that era is over. Interest rates have risen to levels not seen in 2 decades. And the cost of servicing debt, public and private, has exploded. The bills that were postponed for years are finally coming due, and no major economy is prepared to pay them by 2025. More than half of the world's outstanding debt will need to be refinanced. That means governments, corporations, and households will face higher interest costs at the exact same moment global growth is slowing. When debt becomes expensive in a slowing economy, something has to break. Governments cut budgets. Corporations lay off workers. Households reduce spending. And the feedback loop begins. Debt is not just a financial issue, it's a behavioral one. And when the cost of debt rises enough to change behavior, economies contract. That contraction is already visible around the edges. But by 2025, it will no longer be subtle. The second cycle converging in 2025 is demographic. Populations in Europe, China, Japan, South Korea, and even parts of the United States are aging faster than at any time in modern history. Aging populations consume less, save more, and slow economic velocity. China, once the engine of global growth, is losing millions of workers each year. Europe faces the same trajectory. Japan has been there for decades, and the US, long considered demographically resilient, is now approaching its own demographic turning point. An economy built on rising consumption struggles when its population ages. And a world where multiple major economies age simultaneously experiences something far more severe: structural stagnation. The third cycle is geopolitical. Tensions between the United States and China are rising across every domain: trade, technology, military, supply chains, and currency. Russia's conflict with Ukraine continues to destabilize Europe. The Middle East remains unpredictable. New alliances are forming. Old alliances are drifting. And a global system that once relied on stability and cooperation is now defined by fragmentation and distrust. Geopolitics has always influenced economics. But in 2025, the influence is magnified, because the global economy is more fragile than at any point since the 1970s. World divided politically becomes a world vulnerable. Economically, the fourth cycle converging is energy. Oil markets are tightening. Investments in new supply have fallen sharply. Producers are consolidating power, and demand remains high. Meanwhile, the transition to renewables is not happening fast enough to replace traditional fuel sources. Energy is not just another commodity. It is the backbone of the global economy. When energy becomes unstable, everything connected to it, transportation, manufacturing, agriculture, logistics, consumer prices, begins to distort. Periods of high energy volatility have preceded nearly every major recession of the last 50 years, and the world is heading into another one. The fifth cycle is inflation. The world has not returned to normal. Prices have not reset. Inflation has not been defeated. It has simply slowed. But the damage it caused, the destruction of purchasing power, the acceleration of inequality, the erosion of savings, remains permanent. Once inflation becomes embedded, it takes years to unwind. The Federal Reserve knows this. Central banks in Europe and Asia know this, and they also know that lowering rates too quickly could reignite inflation. This means monetary policy will remain tight at the exact moment the world needs support. When central banks cannot cut rates freely, recessions become deeper. The sixth cycle is liquidity. Over the past 2 years, liquidity has quietly evaporated from global markets. Central banks have pulled trillions of dollars out of the system. Banks are lending less. Investors are taking fewer risks. Governments are absorbing more capital through constant debt issuance. And corporate credit conditions are tightening. Liquidity is the oxygen of the financial system. And by 2025, global liquidity will reach its lowest point in more than a decade. An economy can survive many things, but it cannot survive a lack of oxygen. Individually, each of these cycles would be enough to cause a slowdown. But together, they create something much larger, synchronized. Global downturn that becomes nearly inevitable once enough pressure builds inside the system. Recessions rarely come from one cause. They come from the interaction of many causes. And 2025 is shaping up to be the moment when all the wrong forces align at the same time. The danger is not just economic. It is psychological. For years, consumers believed things would improve next year. Corporations believed interest rates would fall soon. Politicians believed growth would return eventually. But as optimism fades, behavior changes. Households reduce spending. Companies postpone investments. Banks tighten lending. And when enough people and institutions act cautiously at the same time, caution itself becomes a recession. The world has seen downturns before, but the last time so many cycles converged was in the early 1970s, a decade defined by stagflation. Oil shocks, geopolitical instability, rising debt, demographic pressure, and monetary resets. The parallels between today and that period are unmistakable. But the world in 2025 is far more interconnected, far more leveraged, and far more fragile than it was 50 years ago. And fragility magnifies shocks. This does not mean the world will collapse in 2025, but it does mean the probability of a deep recession, the kind that reshapes economies, governments, and societies, is higher than at any moment since the 1970s. Some countries will weather it. Others will not. Some industries will adapt. Others will fail. Some families will struggle. Others will find opportunity. And the outcome will depend entirely on how prepared people are for the shift. The most dangerous part of this moment is not the recession itself. It is the denial that precedes it. Most recessions surprise the public, not because the signals were invisible, but because people choose to ignore them until the impact becomes impossible to dismiss. Today, those signals are everywhere, and those prepared to see them will have the advantage. Asterisk, asterisk, this is Global Collapse Report. Subscribe for clear, data-driven analysis that cuts through the noise. The cycles are converging, the pressure is building, and 2025 is approaching fast. What happens next will define the next decade, and the time to understand it is now. Asterisk, asterisk.